Welcome to my channel. I'm Scott, and in this video we're going to talk about taxes. So these are the topics I'm going to cover in this video. We're going to do a high-level definition of taxes, how to figure out how much taxes you pay. We'll talk about long-term and short-term taxes, taxes on dividends and bonds, how to account for losses. I'll give you a couple examples and then a summary at the end. So the simple way to think about taxes is it's a mandatory contribution by a state, city, or government. In the United States, on a federal level, the IRS collects taxes, but each country has their own taxing authority. It's the HMRC in Britain, the BIR in the Philippines, and we pay taxes on pretty much anything. Your paycheck gets taxed. If you buy something in a store like an iPhone, that gets taxed. You pay taxes on your home. It never ends. So how do you know how much taxes to pay? The focus in this video is on taxes on investments like stocks and bonds. Well, first we need to figure out if we even need to pay taxes. An investment becomes a taxable event when you sell it. And if you sell at a loss, you don't have to worry about taxes. It's when you sell at a gain, at a profit. If you buy a stock for $1,000, next year you sell it for $1,200, you have a realized gain of $200. If you buy a stock for $1,000, and then a year later it's $1,200, but you still hold the stock, you haven't sold it, that's an unrealized gain. Unrealized gains aren't taxable. Now to figure out what bracket you're taxed, there are 4 things to ask. How long you've held the asset, what was your cost basis, how much did you pay for it, what bracket you're in based on your income from other sources, and your marital status. But remember, if you have money invested in a retirement account and you receive dividends or sell stock at a gain, you don't have to pay any taxes. But when you retire and withdraw the money from the account, that's when you have to worry about taxes. So you can buy and sell all you like within a retirement account and not worry about any taxes. You just don't want to take any money out of the account, especially before you retire, because then you get hit with a big penalty. So let's talk about taxes on long-term capital gains. And remember, if you sell a stock at a loss, no taxes. And you also don't have to worry about taxes if you don't sell the stock. It's only when you sell it at a gain. In order to figure out your tax bracket, you have to combine your gain with other gains, like in real estate or if you have a business. Let's say you own a stock for over 1 year and you sell it at a profit. That's what we call long-term capital gains. If you invested $200,000 2 years ago in a stock and sold it for $250,000 today, that's a $50,000 gain. And let's just assume you had no other long-term capital gains. You have to look on this list. If you're single, then you don't have to pay any taxes for the first $41,675. The remaining, the $8,325, you have to pay 15% on. And if you're married filing jointly, you don't have to pay any taxes on that $50,000. Let's talk about short-term taxes. If you own a stock less than a year and sell it at a gain, we call that short-term capital gains or ordinary income tax. Let's say you're in college and you don't have a job, you don't make any money from any other sources, and you buy a stock and a couple months later you sell it at a $2,000 gain. You have to pay $200 in taxes. Your tax rate is 10%. 2,000 times 10% is 200. Let's say you're married and you file separately. That means you and your partner don't combine your income. You filed on separate returns. And let's say you made $50,000 at your job. You also had $2,000 in short-term capital gains. That means you would pay $2,000 times 22%. So you would pay $440 on that $2,000 gain. And some stocks pay dividends. Say you bought Microsoft today and 6 weeks later you received a dividend payment. You would have to pay taxes based off of the ordinary income tax rate, which is the higher rate, 10% to 37%. But let's say you bought Microsoft 2 years ago and you receive your dividend. Then you would pay taxes at the qualified rate, which is a lower tax rate, between 0% to 20%, depending on your income. So let's say you were in college and you received $1,000 of Microsoft dividends and you bought that Microsoft stock 6 months ago. Then you wouldn't pay any taxes, because as long as you held the stock for 60 days, all dividends are taxed at the qualified rate, which is the same as a long-term capital gains rate. If you own stock in a REIT, an MLP, or a BDC, Most of the dividends are taxed at the higher rate, the ordinary income tax rate, the one that's 10% to 37%. There are some situations where you do get taxed at the qualified rate, but most of the income from these investments is at the ordinary rate. So if you invest in an MLP at a 6% dividend rate, which you think is great, you may be better off investing in a regular company at a 5% dividend rate, because after taxes, you may have more money at the 5% rate than the 6% rate. Of course, you have to look at your tax bracket. Preferred dividends are similar to common stock dividends, except it's 90 days, not 60 days. In the beginning of the video, I said pretty much all dividends and gains inside a retirement account are not taxable until you take the money out at retirement. That is pretty much true, but if you put an MLP into an IRA and received more than $1,000 of dividends in an accounting year, that's treated as UBTI, unrelated business taxable income. And UBTI is subject to immediate taxation, which is a really unique thing with MLPs. Just something to consider if you hold an MLP in a retirement account. So let's talk about taxes on bonds. Savings bonds and treasury bonds are subject to federal income tax, but they're usually free from state and local taxes. If you buy a muni bonds are usually issued by a state or local municipality. Those are tax-free on a federal level and on a state level if you buy a state bond in the same state you live. So if I bought a California bond, I wouldn't pay California taxes since I live in California. But if someone in New York bought a California bond, they would have to pay taxes on the state level. Corporate bonds are taxed as ordinary income, which is a higher tax rate. You may be thinking, why would you buy corporate bonds? Just buy munis. The thing is, munis pay such low interest, you may be better off buying corporate bonds. Of course, there may be more risk in a corporate bond. When I say risk, I mean risk of default. What if you sell a stock and lose money? Let's talk about losses now. Say you held the stock for 2 years and had a gain of $10,000. Then another stock you held for 3 years and had a loss of $10,000. Since both the gain and loss are long-term, you combine them, and that means you don't pay any taxes. Same thing if you had a $10,000 gain on a stock you bought a couple months ago and a $10,000 loss on a different stock you bought a couple months ago. You don't pay any taxes, it's a wash. Say you held the stock for 5 years and then you sold it, had a $12,000 loss, but you didn't have any other gains to offset against the loss. Next year you carry forward that loss of $12,000. What if you still have no gains? Then you could apply $3,000 of that loss to your ordinary income and reduce your ordinary income by $3,000 and pay less taxes. Now you have $9,000 of carry forward losses. Say the following year you still don't have any gains. You could keep offsetting $3,000 against ordinary income until the entire loss is satisfied. Let's say you had $12,000 of losses. In the next year, if you had a gain of $20,000, then you could offset the entire $12,000 and only report $8,000 and pay taxes on the $8,000. $20,000 minus $12,000. So I'm going to give you a couple examples. This is the first example. Say you buy $10,000 of Microsoft on January 1st of 2022 and sell it for $15,000 5 months later. That's considered short-term gains of $5,000. Say you bought $10,000 of Google on 1/1/2021 and sell it for $15,000 on 6/1/22. That's long-term capital gains of $5,000. Let's assume you're single with no job. Pretend you're in college, so you have no money coming in from any other sources. You pay $500 for Microsoft. Your tax bracket is 10%. 10% of $5,000 is $500. You pay nothing for Google because your tax bracket is 0%. 5,000 times 0% is 0. So as long as you hold a stock for more than 1 year, you pay no taxes on up to $41,675 of gains. So for the year, you would pay a total of $500 in taxes. Here's another example. Say you bought $100,000 Microsoft on June 1st, 2018 and sell it for $150,000 on 2/1/2022. That's a long-term gain of $50,000. Let's say you buy $80,000 of Meta on 7/1/2021 and sell it for $40,000 on 7/5/2022. That's a long-term loss of $40,000. Let's assume you have $10,000 of carry forward losses from last year. So that means last year you sold stock at a loss, but didn't have a gain to apply it against. So you're pushing it forward another year. So your taxable income on long-term capital gains is zero. You had a $50,000 gain on Microsoft, a $40,000 loss on Meta, and $10,000 of lost carry forwards. So $50,000 minus $40,000 minus $10,000. You don't pay any taxes. But I'm just referring to taxes on these investments. You still have to pay ordinary income tax from the money you make at your job. Often taxes are the largest expense when investing. Some people spend a year or two and make a 10% return, then 15% of that return goes to taxes. So taxes really take a big cut of your earnings. And the higher the tax bracket you're in, tax efficient investing becomes that much more important. So if you really understand taxes, you could save a lot of money. I hope you enjoyed the video. Thank you so much for watching. Leave a like, subscribe, and comment. Talk to you soon.